Welcome to CrushTheStreet.com's weekly market wrap-up. We'll start things off in the equity sector, which overall ended slightly down, with the Nasdaq posting the biggest losses, down 1% against the prior session. The big news item for the day was a sudden decline in Google shares, losing as much as 10.5% during intraday trading due to less than expected earnings. The controversy, though, was that the earnings report was released by the SEC hours ahead of schedule, and the finger-pointing, coupled with conspiracy theories, are bound to be major talking points for the days ahead. However, things started off on a far better foot earlier this week. Using the technicals for the S&P 500 as an example, the index had 3 strong sessions before today's little trip up. Reports suggesting further growth in the economy and better than expected housing data all contributed to strengthening investor confidence towards the equity sector. The key target to watch, though, is the high achieved during QE3's announcement. It has been acting as a strong resistance for over a month, and continued failures to penetrate that level could spell a corrective downturn. Let's move over to currencies, which saw some wild action this week. Beginning with the US dollar index, it closed just under the 79.40 level, up 0.41% against the prior session. However, the dollar has been in decline this week as investors push more resources into equities, further confirming the risk-on environment we've been seeing in recent days. Looking at the technicals over the past 3 weeks, the greenback attempted to clear the 80 level multiple times and failing at each one. This week, it's barely holding above the lower Bollinger Band, and the 20-day moving average is acting as resistance. Given the lack of positive momentum, a trip into 78 territory seems likely. On the flip side of this fiat fantasy world, the euro currency has been on a surge this week, today closing at the 130 level. Much of the gains can be attributed to Spain, where a feared credit downgrade did not occur, and there are rumors suggesting that they are moving closer to officially requesting a bailout package. This is interpreted as a sign of intent that the Eurozone will do whatever is necessary to keep the EU intact, and therefore provide much needed confidence in the euro currency. Let's talk about the precious metals. On September 21st, while so many others were piling into gold and silver and expressing very bullish sentiment, we reported that lethargic price action in the PM sector could lead to a downturn, and we forecasted a silver price in the high 32 range. After a lot of back and forth, we finally saw the price drop to 32.70 on Monday. So is now a good time to buy? Let's take a look at the technicals. The most obvious point that sticks out is the breakdown in momentum as judged by the sharply declining MACD indicator, as well as the decreasing volume and RSI metric. Second, the price action is slowly reaching towards the 50-day moving average, which currently sits at 32.38. A close below that would surely signal further downward movement. Third, the high 32 range is what I believe to be a transitional price, meaning that there is clear support in this area, but also there is strong resistance in the mid 33 level. If we look at the price action on September 12th, the day before QE3, you'll notice a small body candlestick with long upper and lower wicks. This tells me that during that particular session, the highs and lows of the trading range varied wildly, suggesting that the bulls were not willing to keep buying at the upper range, but also that they were not willing to sell at the lower range either. Since the sugar rush of QE3 has obviously worn out, it may be harder to push the price past this resistance level. On the flip side, the bulls have shown tremendous resilience over the past month, so it may be just as difficult to drop the price down to $30. Going back to the original question, I personally would approach silver accumulation using a staggered approach. I believe it's important to acquire some positions within the 32 range, as it does not pay to get greedy in an obvious bull market. Then, should prices decline to 31, 30, or even 29, you will still have some powder in the keg to acquire at these discounted prices. However, $29 silver is hypothetical at this point, whereas 32 is a sure bet. Like I said before, don't get too greedy. We are approaching a period of seasonal strength for the metals, and you don't want to get caught off guard on the next uptrend. And that will do it for this edition. Thanks for watching, and we'll see you next week.
For more unconventional ideas, please visit CrushTheStreet.com.